Greetings. My name is Richard Polero. I'm a member of OIC, a private equity investor as well in assets promoting sustainability. OIC is a group of alumni from various Oxford SAID investment programs in like-minded industry experts. Its purpose is to enhance discussion and information sharing between leading experts, investors, investee companies, and to build a secure future in impact investment collaboratively. Today, we're pleased to present our asset owner panel. After featuring 5 events, 1 panel on greenwashing, we move here to directly hear from asset owners. This is a candid discussion amongst experts to explore the why, what, and how of ESG and impact investing. We are excited to feature a diverse and distinguished panel, including family offices, private banks, philanthropic capital, and specialized impact investment consultants. Running through the panelists in no particular order, Tony Schwartz is an impact investor and active philanthropist through various organizations. Through his experience in the venture capital and family office space, his extensive knowledge of the European impact investing landscape. In 2013, he co-founded Voluwatch, a Greek parliamentary monitoring organization that aims to increase political accountability and transparency. In 2016, he founded Gorilla Foundation, which supports progressive social movements and activists working towards bringing major systemic change across Europe. And in 2018, he co-founded the Center of Sustainable Finance and Private Wealth at the University of Zurich. Most recently, in February of this year, he works in the Berlin-based think tank Finio, advising high net worth family offices, high net worth clients, and foundations on tactical impact investing allocation. He's based in Munich. Patrick Elmer is the founder of CEO of iGravity, a Swiss-based consulting and investment advisory firm specialized in impact investing and building a more equitable and sustainable financial system. He co-chairs the board of the Impact Linked Finance Fund based in the Netherlands. And prior to that, he was head of business development at the impact investment firm Blue Orchard. He's based in Zurich. Ian Chesham is the senior director of the Barclays Bank Charities and Not-for-Profit team. In this capacity, his role is directly advise and support clients through change, challenges, and capturing opportunities. He has undertaken a significant amount of work in ethical, ESG, and sustainable responsible impact investing to create bespoke investment strategies for these clients. And he started his wealth management career in Rendsburg, where he managed portfolios, charities, and individuals. He's based in UK. And finally, on to our moderator, Greg Robbins. Greg is an investment advisor. He founded Robbins Advising to advise clients on how to deal with complex situations that they face in the management of their personal wealth and business interests. His career has spanned leadership roles in wealth management divisions of banks such as Citigroup, UBP, and UBS. Greg has taught leading business schools, including the executive MBA programs at NYU Stern School of Business and the New Economic School in Moscow. He's also a frequent writer and commentator in media outlets on issues including sustainability and ESG. Coming full circle, he is also an alum of Oxford University, where he studied in the master's and doctorate programs. He's based in Geneva. With that, I will, but just before I hand it over to our moderator, Greg, I'd like to just introduce and highlight Robert Polero, who will be hosting and coordinating questions. We received several pre-submitted ones and also will remain open to receive more. Robert is a Swiss family office advisor with keen focus on sustainability and impact investing. He's based in Geneva. And with that, just a note that we will be recording this event. And with that, over to you, Greg.
Richard, thank you very much. Thank you to everybody for dialing in, taking time. Everybody's busy, and we will do our best to make the time worthwhile for everybody. So as Richard had mentioned, there's quite a few questions that have come in, which is a good thing. We'll get to those, but we're going to start with a discussion amongst the panelists. I'm just going to make a couple of comments to maybe frame the discussion a little bit. Firstly, I think what I would like to aim for is what I call an ideology-free debate here, meaning the goal of this call is not to convince everybody that impact investing has all sorts of benefits for the world and to get into that aspect of it, although that's important, and many people you can see on this call believe that really the goal on this call is to talk more about the benefits to the investor of doing this, how to do it, how to become more involved in that. And in that regard, a book that I highly recommend that many of you maybe have come across is called Net Positive by Paul Pullman and Andrew Winston. It's getting a lot of discussion in the business world and in various circles. And the crux of the book is to say that doing good for the world, what they call being net positive, is actually good business. So if you do the right things and you treat the environment and you treat your stakeholders and you treat this world with respect, that you will be rewarded with better business results and better valuations and the like. And I think that's really relevant to this call, because essentially what we're going to talk about is whether green, ESG, sustainable investing, impact investing, whatever we want to call it, whether that is actually good investing, apart from doing well, doing good for the world, will that actually bring benefits to us as investors? And I think that's the question, and then we'll kind of go through that. Now, the follow-on to that is to say 2020 and 2021, that was a pretty banner time to be a sustainable investor, because if you did that, you were greatly rewarded. Most of the impact and kind of ESG funds were heavily tech weighted. As we all know, the returns were very commensurate there. And so it was pretty easy to be an ESG investor in those years. 2022 is a very different time. Obviously, the markets look very different. This horrible war that's going on, the impact on the energy markets, has led to some different possibly considerations, and even groups like BlackRock that were amongst the most outspoken investors on ESG are starting to modify a little bit their investing positions and suggesting more kind of diversification and consideration of more energy related areas. So I think it's a very opportune time to have this discussion and to have an honest kind of debate about what are the pros and cons of investing in this area. So with that, we're going to go into kind of the topics that we want to talk about, ranging from the motivations to begin considering impact investments in your portfolios, to looking at asset allocation, meaning if you are interested, what would be the right way to think about allocating assets in that direction, what percentages, what weightings, and then we'll get into returns. I know a big question that's come in is about financial performance. Do we have to sacrifice financial performance in order to invest in impact? And then we'll get into more specific questions about tools, funds, and other things there. So maybe with that as a kind of backdrop, maybe we start on this question of motivation. So for the investor that maybe is not so inclined at the moment to allocate to impact, what would the panel say are reasons, again, apart from some of the ideological reasons, but from an investing standpoint, what are some of the compelling reasons that one should consider getting started in there? Who would like to kick off? Ian, do you want to kick off?
Yeah, please. Thank you. Welcome, everybody. Thank you for joining us on the call. I think motivation is quite a key one. I presume most of us on the call are believers and really what are positive on this, what's possible and sustainable and impact investing. But as you said, it's not true of everybody, and that's, you just have to realize that we're not all as enthusiastic as others. And so what are the other motivations that can drive that? And I think about the UK university sector. So about 7 years ago, just a single university had divested from fossil fuels. But if you look at it today, it's well over half of the universities in the UK have divested from fossil fuels. And we're heavily involved with those conversations, and it is fascinating to see what the main drivers are. And it's not necessarily to do great things for the world. It is my peers have done this, my competitor university has done this, therefore I need to do it. And sometimes I'm just looking for simplicity. One of them admitted we're just virtue signaling, but we need to do it. And so you do then have to talk about, well, your students are looking for this, your stakeholders, your professors, your employees are looking at what you are doing. And as we talked about, and what you look at in terms of performance, and I will talk about later, is you want people committed to your company. You want them committed to the university, and that will drive growth and performance in companies as well. So motivations are not always altruistic. They are sometimes financial, sometimes peer related, sometimes internal pressures. It's about making sure that they understand what they're doing and do it in the best way they can.
Thank you, Ian. Patrick, Tony, what would you like to add?
Well, I think that the intentionality is actually quite important in impact investing. The Global Impact Investing Network, GIN, if you look up their website, they have the definition of impact investing, and the number one factor is intentionality. So there has to be an intention to create measurable impact. So I would argue, if you don't have the motivation to generate impact, if you're not also intrinsically motivated, you're actually not an impact investor. And of course, there are also financial arguments for impact investing. Many of you know the endowment model of David Swensen, which focuses a lot on alternative investments and finding specialist investment managers. And I think impact investing or sustainability is a mega trend that's going to stay. And the next 10 years are super important in meeting sustainability goals. So there's a very strong business case. But again, I would say if you're not motivated to generate impact, you're not an impact investor.
Interesting. Patrick, you're advising people on this. Is intentionality essential? And if you're not intentional, you're not really in that direction. You agree?
Yes, I first of all, thanks for having me here today. I think it's really great. What I always say is that there is not one type of impact investors, because people, they like to classify and cluster. So there are as many types of impact investor, obviously as many types of investors, and that drives very much, also the reasons why they might be looking or investing in the space. When it comes to private investors, high net worth, it's very much driven by their values. When you look at more institutional investors, banks, pension funds, obviously they need to generate financial return. So that will never go away, even when they look at impact investing. But then they're also looking at, building more resilient portfolios that are possibly less correlated with global markets. And also they're getting pushed by their own clients about impact investing. So they need to know. Last but not least, foundations and development actors, they're also trying to figure out how to complement the work they do on the charity side with impact investors and impact investment, because obviously they work more and more with enterprises that support their causes, and they realize, giving them a grant doesn't make too much sense. From my personal perspective, a bit as you mentioned in the introduction with the net positive, I think there are certain trends that will not go away, and some companies will just come up with solutions and become champions on that. And identifying these companies will certainly also be an important driver of impact investments.
Okay, thank you. Let's just kind of take off of that and move towards a little bit kind of asset allocation discussion. But I just want to, the difference between impact investing, because there's different definitions in here. There's impact investing, there's kind of ESG measures, which then brings in a much wider spectrum of investment considerations. And I know the research that I've done, looking at this, a lot of the companies that are at the top of the ESG rankings, be it Apple or Microsoft or some of the tech names, are held by in many different portfolios, whether they're seen as ESG or not. So I guess, with that as well, there's an avalanche of funds and products that are being labeled in one form or other, green or sustainable. So for any investor, it's hard to avoid this growing volume of investments to consider. So maybe you could all address this issue of asset allocation. So an investor that has a fully allocated portfolio and wants to begin to think about incorporating impact as part of that. wants to think a little bit about ESG and whether it's an idea to use that as a measurement for investing. What are your thoughts on those issues? Maybe start with Tony this time.
Yeah, I mean, there's in terms of impact measurement, there's a lot happening. There's the IMP project, which you might have heard of, which is slowly starting to become the standard together with the operational principles of impact management. So I think these two initiatives are actually quite important. And yeah, I don't know, Greg, into which direction you want to take me to take the question exactly. If you can direct me a bit more.
Yeah, just if you look at your own portfolios, I mean, how do you think about creating, on the one side, a proper allocation, diversification, all the good basic principles of investing versus convictions on impact? And how does one find a balance if one is not just fully 100% on impact, but wants to create a proper full portfolio?
Yeah, I mean, this has to do with the size of the portfolio that you're managing. You know, if you have a certain size, you can start to diversify across different types of alternative assets. And you know, if you want to go into the big buyout funds, you cannot get into it with $1 million or even 5 million, sometimes not even 10 million. So it definitely has to do with size. And yeah, for me personally, I mean, it's really a matter of your personal preference. I personally want to have a bigger impact, so I'm trying to go into funds that have more difficulty raising funds, also to some extent, that are first-time managers. But I understand that if you have a strong fiduciary duty, because there are many family members, or the principal is more conservative, then you need to approach it from a more institutional perspective and say, okay, we're going to diversify over different types of private equity managers, private equity types, and vintage years, etc.
Okay, so that idea is to create an impact portfolio which is diversified, right? And then there's the other idea of creating an asset allocation which itself has impact as a part of it, but is otherwise
yeah, and I think for the buyout funds, it's difficult to find a suitable product at the moment, I think. And also in the hedge fund segment, it's not that easy. So there are certain types of private equity, like super mega funds that, you know, like the biggest impact fund, I don't know, is like maybe 2 or 3 billion. And yeah, I think the biggest private equity funds that would maybe laugh at the size, or maybe not laugh at the size, but they're huge buyout funds.
Right. So, Ian, how do you look at that from Barclays' perspective?
Yeah, thanks, Greg. Yeah, we look at it kind of a higher level, that's at a holistic level of how do you implement, as you say, what do you allocate to different elements. So I think you made a good point about the difference between ESG, sustainable, and impact, and it's quite key to know that. So you have ethical funds which exclude sectors. You have ESG strategies that is pretty commonplace now, where they're looking at kind of non-financial elements of companies. And then you have sustainable, where they're trying to have a positive influence on the world, also screening ethically. And then you have impact, which, you know, the group here will tell you even more about, but it's more about having that catalytic change. So when we're talking about to clients, often they're in a traditional portfolio of multi-asset class bonds, equities, etc. How do you make the first step? And that would typically be into a sustainable strategy, which is trying to have a positive influence on the world, or at least do no harm, I think. So that's where we typically go for, because that's familiar with people. One multi-asset class portfolio to a positive one that has more rigor around its ESG credentials. And exactly about the private asset program, you will see allocation. So you can do a core satellite approach. So you have your core, you have liquid sustainable that's visible and transparent in terms of what it's doing. And then you can have your private assets where impact can have a really true catalytic change. And we see anyone up from 10% to 20%, depending upon the experience of the foundation, the charity, the longevity of it as well. We've seen much higher as well. So, and exactly as we were speaking about earlier, it depends on the size. The bigger the fund, the more diverse you can have your private assets exposure. So I think the market's developing where you can possibly have a fund that does that for you. we're not there particularly in that, but it's fascinating to see. And there's easy steps before you go into the full impact, but you could start there as well if you wanted to, as a kind of a satellite approach to what you're already doing.
So it suggests that people are looking for guidance. It's still a learning curve.
Yeah.
Patrick, that's good for your business, for iGravity. So what do you tell people when they're thinking about these questions and starting to put their toe in the
I
water?
wanted to share a bit of our story, not to repeat what my colleague said, obviously biased by the work we do, because at iGravity, what we do is actually building impact investment portfolios. And the background of that is I've been working in microfinance for many years, and I've seen, for example, Blue Orchard, which has grown from a couple of 100 million to managing billions, including from pension funds, bank, insurance company. And many of these investors were relatively happy with performance and impact, which, to be honest, were not always stellar, but struggled to find follow-on investments. And combined with that, I still feel there's a bit of disconnect about all the debates and discussion about impact investment, and the reality when you go to your own bank and you ask for where you can put your money, and there is not much they are able to show you. So we wanted to change that by building, a model portfolio of impact investment in the semi-liquid space. And when we started 3 years ago, it was incredibly challenging to find 10, 15 lines investments which had a certain size and a decent track record, and we had to learn to build an investment process that would allow us to look at the financial side, but also an impact assessment. How do you actually compare a number of microfinance funds and bonds, for example, from the impact perspective? So I think the market is certainly evolving. There are more and more products, larger products, more track record, which is making it easier, but still not very easy.
Okay. Well, that kind of leads us into a more interesting set of questions still on performance. And there are a lot of questions, by the way, from the audience about performance and performance-related matters. And again, going back to the remarks I made at the outset, is sustainable investing good investing as well as good for the world? And so the real question here is, if people want to increasingly allocate to impact, do they necessarily need to make a financial trade-off? Is it necessarily the case that there will be some compromises on either investment returns or diversification? And the example I gave earlier of if you choose not to allocate to the energy sectors, then are you leaving money on the table, and are you losing some diversification that you really need today in these markets? So who would like to start with that?
I'm happy to talk about the sustainable one. That's been my area of focus. And returns, we've got a fiduciary responsibility, we've got stewardship of the assets, and so it's right to ask that question on performance. But I think that the evidence is building and has been for long term, so not just the last 3 years what's happened, but if you look at just simple index trackers that have ESG, which are fairly basic, but you can see that there's either neutral or additional performance by having ESG factors considered in there. And when you start thinking about that makes sense. If you've got strong leadership team, you've got to focus on your employees. Well, then that should be a better company. And then I think about the analysts, how they used to look at a company, cash flow and investments, dividends, things like that. Well, you can still look at that, but there has to be a whole element of non-financial elements. And that's what the ESG kind of focuses analysts' minds on and people's minds on, of how good is this company, not just on its financial metrics, but also on its ethos and its values that underneath that. And that creates a more sustainable business. If it's not short-term focus, it's more long-term focus. It's employee development, et cetera, on that element. So for us, it has no negative impact on performance. The little story I always quite like, and it's when you just have no idea will happen. And so during COVID, there was this UK company that had always had a strong health and safety record. So all of its employees were more than 2 meters apart from each other. Nothing to do with COVID. That was just the way they operated. So when COVID came, they could still work on their operating line. They could still produce goods because they didn't have to change anything. Now, you can't analyze that. That's just a bit of luck, but also good ESG has meant that they looked after the employees and they can carry on working right through a crisis. So for me, it makes absolute sense to do so, and the academic evidence backs it up too. But I'll leave it to the rest of the panel to talk about the impact in strategies.
Tony, what do you think? Any trade-off, financial performance and impact?
Well, I mean, it really depends. There's finance first and there's impact first in impact investing, right? And I mean, when it comes to when we're talking about private equity here, I mean, obviously, invest ESG stuff and voting your shares and engagement is also important. But I think the real juicy part of the impact investing is the private markets, where you have real world impact. There, it also has to do with manager selection. So you're in the same conundrum as with the regular non-impact world. But I think sometimes the problem is the track record, right? Because if you have new funds with new teams, not having a track record is a bit of a problem. So I think that's traditionally been one of the problems of impact investing managers, is that they had to have like 5 or 10 years. And I think now we're seeing funds like fund managers like Blue Orchard and others. Leapfrog is another one that has made a lot of news, that they are ready for institutional capital because they have the track record now. So they tick all the boxes, and that's why a lot of of these impact fund managers are finally getting the bucks that they deserve.
Yeah. So as a maturity in the investing world, which
for sure.
To investors, that makes sense. Patrick, anything to add on the whole trade? Because again, this is really kind of critical right now, because clearly, if you're avoiding all of energy, I keep going back to that, you're leaving money on the table today. So how do you deal with clients on this issue if they're skeptical about sacrificing any performance in order to create more impact?
Yeah, along the lines of especially what Tony just said, I think first of all, no need to compromise. I think research has shown that impact investment can deliver similarly attractive return. Even this year, where many things are down, impact investment has performed relatively well, with the caveat that you have a lot of opportunities in the private debt space, for example, where valuations take place on a monthly and quarterly basis. So there is much less volatility, and some of these enterprises are more insulated from markets. But in general, I think the good thing is no need to compromise. But the second part of my answer is it depends on what you're looking for, because sometimes we meet with investors that say, I want to invest in the education space in East Africa. There is a growing sector of affordable private schools, for example, for low-income households, especially in the region where the government is not able to provide decent education. And you can actually invest in these low-cost, affordable private schools to help them build classrooms, infrastructure, hire teachers. But obviously, if you have such a dedicated strategy and you're working in really vulnerable communities, there is no way you can get the return which is commensurate to the risk you are taking.
Okay, that makes sense. I'm going to pose one more set of questions, and then we're going to turn it over to Robert to start introducing some questions from the field. But I guess the tenor of our discussion so far has been very positive. There's a lot of opportunity. There's no compromise in financials. It's a great story. So then the question is, if you are going in that direction, how do you manage the issues around greenwashing, around lack of standardized measurement systems, obviously misrepresentation in some funds, and just kind of using the system, apart from hiring folks like Patrick and Tony and others. So how do you manage that? Maybe we start with Ian from a Remove perspective, and then move over to Patrick and Tony.
Yeah, that's fine. I mean, people say greenwashing all the time, and I don't know if it's quite as a problem as people think, but for me, the general philosophy is, if you want to go down this road, that you find a manager that's committed to this, that's passionate about this. There are plenty of people that will kind of give you the top level story, but don't know the depth. The panel here have depth of knowledge and experience and are passionate about it. So that's what you're looking for in your advisors, I would say. And go through the track record of the strategy, how robust it is, the underlying processes on there. Regulations are coming in as well. So you've got the European regulations on the definitions of what different strategies are. So they will start to help, and that's going to change. if you start to see the regulators lead on that front, so that will do some of the heavy lifting for you. But I think for me, it's always try and find a manager or advisor that's passionate about this, that's been doing it for a long time, and they will, you know, point you in the right direction, advise you, and help you and support you in everything you need to do, partly education, partly advice in terms of how to implement it. So we're all worried about it, but I'm not sure it's a big issue as people fear, but I might be wrong on that.
Patrick, is greenwashing not such a big concern? It's easy to manage?
No, it actually is. I'm actually glad you also bring up the challenges, because I don't think everything is glancing and rosy. I think, I mean, as you alluded to, the big challenge of the industry is that there is no impact certification. So anybody can launch an impact fund, you know, and we have many of them, and some of them really are not creating an impact. So investors get very confused. I mean, already between sustainability, SRI, ESG, and impact, there is lots of confusion. I think the more confusion, the more scared investors get. Then, I mean, we mentioned that the product universe is limited, so there is not a very large choice. And then I think we also need to mention that transaction costs are high when you do impact investing. So you end up, in many cases, paying more than the more traditional investments, which also for some people is carrying them away.
Tony?
Yeah, I mean, what I mentioned before, the impact management project and this operational principles of impact management, these two initiatives, they are signatories to both. So I think if the organization is involved in those, that's already a good thing. And there is now more and more this topic of impact audits coming. There's a company called Blue Tie that actually very much specializes on this, and audits the impact results from these companies. So I think these are actually quite good initiatives, and but still, you know, you just need to look a bit deeper about the motivations of the management and the firm who's starting the fund,
So it sounds like thank you for that. It sounds like a combination, right? It sounds like we investors need to do our homework and we need to dig deep. The regulators in the system are helping because they are starting to create standards. And as well, it was said that the investment industry is, in this regard, is maturing, and so that over time will weed out the firms that are not doing the right thing. So I think directionally we're moving in the right direction, which is a positive message. On that note, why don't I ask Robert to join us and bring up some of the many questions that have come in.
Sure.
Robert?
Thank you, Greg. Thank you. And there have been many questions, so I'm trying to sort of collate the questions so I don't answer your questions, ask your questions specifically. Hopefully we'll get to it now or in another session. The first main question is regarding investors and their desire for transparency. And to what extent are investors really looking for transparency in the impact claims? And how do they sort of satisfy that desire, for example, with third-party assurance? And I think some of the things we've touched on a little bit, are they looking for assurance by, for example, Blue Mark Tideline? And then I think that the second part to that question is, you know, what are you looking for in the manager? What does sort of a dream team look like in an investee in terms of skill sets, people they're hiring, for example, to do the impact measurement, to look on the financial side, and how are they all working together? So I guess a two-part question there.
Who wants to start? I said the tough questions were coming in the second part of the talk. So, Ian, why don't you?
Yeah, that's fine. I'll pass these on straight on afterwards. I do. For me, it's it almost reflects on the last question. We're not perfect. You're going to look at if you look at MSCI and Sustainalytics, with the two of the world's largest kind of ESG rating companies. They got the same company have a completely different record of it. So it makes it hard for someone on the outside of that to look into what's right and what isn't. And some of it is just subjective. You know, how much of a control do you want Jeff Bezos in charge of Amazon, or do you think it's a risk because he takes too much control of the business? You know, what's the answer to that? Maybe it's all right with him, but it might not be with others. So there's lots of different things. But for me, if you financially audit a company, then you should probably impact audit as well. And I think that's the desire to come through on that. We are seeing it, but it's still early, I think, is probably the main message. And we're happy to work with people. And that's, I think, what you're seeing here in these kind of calls is people are learning, people are improving, regulations moving forward on it as well. But for me, it's important to have that external audit to give confidence in everything that we do, especially as you're starting off on things.
I just interject one point, because any notion of transparency, forget about impact, but in general in investing, there's what has to be disclosed and then what people want to disclose, right? So I think it's been said that the regulation is evolving and growing, and that will force disclosure, right? And that will force standards, and it will make it easier to compare. But then there's also what people willingly share, and it's really that latter in particular that's important to evaluate. Patrick, Tony, some thoughts on transparency and how to overcome that?
Yeah, Ian, go first. And Ian.
Should I go?
Patrick, go ahead.
Okay, good. Yeah, I mean, again, I think you're right. I mean, transparency is still limited, especially if you're looking for publicly available information. There is not much. To get the information and the data, you really need to engage with the managers and the company. So there is lots of work to be done. In our case, what we do when we look at managers, we start by trying to understand the impact thesis of the manager. What is the objective from an impact perspective? And then we look whether there's any data and evidence that actually certain activities will lead to specific outcomes. And then, as mentioned earlier, the commitment of the manager to impact. So do they have people working on the impact side? Are they actually engaging with portfolios company? And then I think a key criteria is the additionality. Is there additionality in this new financial product? Because to make a simple example, if you launch the 15 microfinance funds, which is doing exactly everything that all the others are doing, the value in the market is limited, as opposed if you, for example, provide funding in local currency that nobody is doing yet. So there are a number of questions that can guide you in assessing the impact, but again, it's a lot of hard work, and I think the industry needs to move towards more transparency.
Patrick, let me ask you a question, because I know that you guys advise individual clients on decisions, as does Tony. Do you guys also, and when I say you guys, do other firms as well, put out things like newsletters, research reports, more for general consumption, right? Because there's the bespoke, a client can hire you, but if people are just wanting to get into the area and start to look and see what's around, do you have more general things people can consume?
Yeah, we do that, and we have done that. So we have published a few things, and we have done webinars with the intention of educating and raising awareness. So certainly, I think that's important. I think.
Well, that helps on the transparency side. Tony?
Yeah, I mean, the GIN really has some excellent reports, and the Impact Management Project also, I think, has a very good bibliography, and yeah. So those are the resources I would mention. And maybe I can also mention that I'm involved in this university unit in Zurich, at the University of Zurich, that actually provides also executive education courses for wealth owners on impact investing. So if they want to get like a crash course on impact investing, the Center for Sustainable Finance, Private Wealth, they offer that.
Excellent. Is that a short program? Is it a longer program in case people
it's two sets of 3 days, so 6 days in total.
That's doable. Okay. Thank you. Robert, fire away. More questions.
Sure. So the second, I guess, two-part question is sort of gets to the movement of the shift of assets towards sustainable and impact investments. And the first question is around data and track record. Is there enough data really to support from sort of an academic empirical perspective the investments in, for example, ESG funds? Oftentimes when you're looking to invest in a fund, an ESG fund will have 1 or 2 years of track record, and as a fiduciary, sometimes that's hard to make a recommendation on such sort of limited time frame. And will sort of increase in data over time help in that regard? And the second is a question that came in regarding the role that DFIs and CDCs, such as, for example, European DFIs, have in supporting the mainstream investors and moving towards more responsible investment. for example, in harmonizing indicators to measure impact, standardizing frameworks and regulations. So I guess the main is sort of, data and third parties sort of helping perhaps a shift towards sustainable and impact investments. What role do they play?
Well, we've talked around this subject. So the question is, I guess, are we there yet, or how close are we to being there? So are we 1 to 2 years away from really having the kind of data stream that we'd like? Where are we in the process for total comfort, I guess is the way you might put it. Ian, what do you see?
I think it's changing rapidly and has done, but we're not there yet. I was just looking at some analysis. There's $630 billion worth of ESG bonds due to be issued this year, which sounds a lot, but it's still quite small in the grand scheme of things. So, but the longer they're around, the longer that we have funds, the more data there is, the more robustness it is. Competition drives improvement as well. So we see competitors, fighting for new money, and they'll improve their standards too. But I think we're still a way off if you want to. There are ESG strategies that you can back test. I never really like back testing, if I'm honest, because it always proves that you did the right thing. But it'll happen. We'll get there. I mean, some of the trajectories we're on now could change. We could, work out something different. And that's quite exciting about where we are now in the world. And there are some consolidation around what ESG looks like and impact might look like, but it's still pretty early. And it can be individual as well. So I think it's exciting and the future is good, but it's still a fair bit to go.
Tony, you agree? Early stages?
Yeah, I mean it's still at the early stages, but I would say we last year and this year is definitely like a breakthrough year, and we're in a kind of a parabolic development here, and so yeah, I think it's exciting times, and I also think that impact investing ultimately will become mainstream, because it also makes a lot of sense to not only look at financial metrics but also non-financial metrics.
Okay, Patrick?
I also am very positive, but to give you a bit of color, if I go and see a pension fund here in Switzerland, they will ask me for 10 years of data and at least 100 million in assets under management, which probably 80% of the impact investment opportunities cannot meet. If I go and see a Swiss bank, they will ask me for impact and daily liquidity, which is probably not possible. So I think, that's where the education and the awareness raising is important also for this audience. And maybe to speak briefly about the other question about DFIs, I think DFIs can play actually an extremely important role on harmonizing standards. But also, there is a big thing today called blended finance. So again, I always take the Swiss investor as an example because they sit here next door and they are kind of conservative. So if I tell them to put their money into an impact investment in Africa, they will feel very uncomfortable. And that's where DFIs can actually play a role in offering some protection in potential losses. And there are, a large number of funds which have this public and private investors as a mechanism to mobilize more finance.
Just a follow-on question that comes to my mind. Do you find that the impact in investment firms are learning, right? Because what's been said is that it's becoming more mature, that they have longer track records, but are they also learning what investors need and providing, from your vantage point, the liquidity that's needed, the transparency that's needed? Do you see a shift in the managers apart from just simply being around longer?
I mean, some of them become successful and some will vanish and fade away, first of all. So I think the ones that make it, that have the longer breath, they necessarily get stronger and they learn. I think the issue of liquidity is a big topic for the industry. I mean, it's the nature of impact investing is investing for the longer term. I think it's a bit more of a structuring and financial engineering work, especially in the UK. There is lots of good thing happening on that side. Again, I'm confident, but it takes time.
Okay, thanks. Robert, more questions?
Sure, and I know we're starting to run short on time, so we have 3, and I'll try and wrap them all together, and then I'll turn it over to you and Richard to close. The first one is around financial returns and impact and collinearity. So to what extent are financial returns and impacts collinear? Are they sort of reinforcing for some businesses, not for others? If so, which cases? The second is regarding sort of impact reporting, and is it possible to valorize the impact? There's a question about almost tokenizing the impact. If the measurement gets to a point where you can actually really, have strong data around the impact, can you valorize that and trade it, for example? And the last part is performance. To what extent should should managers be tied in terms of their own financial performance, carried interest, and so forth, to impact metrics? So,
Let's start with the last question. So maybe Tony, if you want to start, how do you see that financial metrics and impact metrics, and how should managers be evaluated there?
Yeah, I mean that's one thing that I really look for when I'm investing in an impact fund. If the people are really intrinsically motivated and care about impact, they will also tie it to their compensation scheme, to their carried interest. So I think like usually it's 50% that is tied to that. And I'm actually part of a fund. I invested in the fund where I'm in the advisory board for the impact evaluation of the fund manager. So the fund manager actually develops KPIs, impact KPIs for each investment. And then these KPIs have to be confirmed by the advisory board, and they serve as the basis for this the carry structure. And the EIF also works a lot with this. They have their own methodology. I think it's also online. So I think it's really important, the impact carry.
Ian, from your side?
Yeah, I think it's becoming embedded in the system, if you think about it. So if I think about, and I was talking about the ESG bond issuance before, a lot of those, the interest rate on those long-term bonds is dependent upon your improvement in environmental considerations typically. So you have to meet those targets. You can't just say that you will and don't. So there's actually already a financial incentive to make sure that you're delivering on what you are. And these tend to be the large liquid bonds rather than impact investing. But you can see how it's starting to be built into the system that you need to make improvements as a company. And if you do, you'll have a lower rate of interest on your bonds and debt, etc., things like that. So I know it go back to transparency, doesn't it? The more transparent, the more trust you have, the more you're willing to take a view on newer funds and commit more money as well.
Super. Patrick?
Yeah, I think it's a fascinating question. I mean, we're actually working with a few foundations and the Swiss Development Agency through the Impact Linked Finance Fund, where we finance enterprises in sub-Saharan Africa, and where the terms of the financing is connected to specific outcomes. For example, we would finance an agricultural company and agree on the percentage of smallholder farmers they will source over the next years, and the more successful they are on the impact side, the less they need to pay back to the foundation. Which is, again, it makes sense for development actors, philanthropic actors that want to do impact investing, and is actually connecting financial and impact metrics.
Interesting. Robert, did we cover those questions? I'm going to have one last question for you, but was there anything we missed there? Because you mentioned a few parts of that.
Yeah, I think the other part was just around collinearity, whether impact and financial returns are sort of collinear and reinforcing. And then can you sort of valorize the impact metrics that are achieved? So we kind of touched on those, but yeah, I think you touched on those.
That kind of got addressed. Let me try to end with maybe just a little bit of a provocative thought, which is, this call, but apart from being very interesting and very engaging, has been very positive in nature. I think if people tuned in at the beginning and were questioning, I think there's a lot of good stuff to come out of this to say, hey, I need to go back and do some research and take a much closer look if I'm not already. To go back to the way I opened, I mean, the world is different in 2022, and if we look to the last years of investing, we had free money, basically. We had some tremendous valuations in the growth area, in the tech area, and it was pretty easy to align, let's just say, kind of sustainable goals with achieving returns. The world is, I mean, investing is challenging in general today. I think everybody on this call who in some way is investing or overseeing investments is not having an easy time. So the question is, how do you think about this today, when some of the leading ESG names are getting clobbered, money is starting to have a premium, there's inflation, rates are coming back, so the costs, I guess, the costs of making mistakes and the costs of not diversifying and the costs of leaving some sectors on the table, notably energy, start to rise. And either for our own money that we manage or for others, how do we kind of reconcile that if we want to stay on that path? How do we meet those challenges and stay the path when the costs continue to rise? I know that's a difficult one, but Ian, why don't you start there?
Thanks for that. Yeah, thanks. No, I think, yeah, I mean, I think you've tried to, well, we've all tried to be fair and balanced in terms of what we're saying. So one of the ones we are seeing is that ESG funds and impact funds tend to not pay income. It's the big oil majors that pay income. So that can be an issue sometimes for people that want income rather than total return. That's a diminishing number of people, but it's still there. So that is an issue. I always think about BP, which share price hasn't moved for 20 years. It's generated almost no return. And I always feel a bit sorry for BP because when oil price had fallen to almost nothing, they weren't allowed to get any bailout. And now the oil price has gone up, they're going to get taxed. It's a tough environment for them. So for me, I mean, you just got to look at the long term. A long-term sustainability of the business will outperform these more cyclical businesses that have no pricing power, especially in an inflationary world. And regulation is going to see them as a cash cow potentially to fund renewable projects and things like that. So I know you've said, oh, it's difficult. Fuel companies are doing really well. Is that lack of diversification impacting portfolio performance? And it is, but I don't think over the long term it necessarily will. But I'm welcome to see what the panel thinks as well.
If you have the luxury to have the long-term view,
Yeah.
I try to do that. I mean, but some people don't feel that luxury. So, Tony, how do you see that one?
Yeah, I also try to think at the 10-year view, and it's just a part of the journey of being an investor that maybe there are years where things are not going so well, and unfortunately this year is like not looking to be good at all, because like China is in difficult territory, and Europe and the US as well. So we're like in a huge mess. But yeah, I think like as an investor, you should have a long-term horizon. If you have a short-term horizon, then obviously you have to adjust accordingly.
That makes sense. Thank you. Patrick?
I'm going to disappoint you, Greg, because I'm not going to say anything different. I mean, how is the world going to look like in 6 months or in 12 months? Nobody knows. So I think it's for the longer term, and it's not about daily trading. And what we discussed today, it's about diversification, it's about manager selection. So if you do a good groundwork, I think it's going to pay off.
Thank you. I agree. I mean, look, I think this is a discussion we all have as investors, short-term, long-term, looking at the bigger picture. It's not about sustainable investing, it's about basic investing, right? And so if you get too close to things, I always tell clients, please don't look at the news every day. I think we all will be better off, and this, clearly there'll be more things to come. So look, we promised a hard stop at an hour. We're going to actually deliver on that, which is impressive always for a Zoom webinar. Firstly, just to thank all of you guys, because this has been really lively and interesting, and I think a lot of information is there. Thanks to Robert in particular, because Robert, apart from posing the questions, has been the driving force between getting this going and getting everybody involved, and does so much work behind the scenes. The rest of us just show up, but he's done the real heavy lifting. And then Richard, maybe you and the nice group at OIC, thank you for hosting this, for inviting us to this. And maybe you want to appropriately get the final word, and then we end spot on at 3 o'clock.
Absolutely. Well, I want to echo your sentiments, Greg, in thanking all of our panelists, thanking all of our participants, and Robert and Anna, and really being the driving force behind this terrific panel. We've had a tremendous turnout. I think we've all heard really fascinating touch points, which you just summarized, Greg. And I want to just say that the recording is available, will be made available. And we will also have upcoming events where we'll be, among them, talking to investment managers investing in impact and sustainability. So we look forward to seeing all of you again, and thank you very, very much. And we're on the hour.
Thank you, Richard. Have a good day, everybody.
Thank you.
you.
Bye-bye.
Bye.